Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. I got an interesting article here for you. Comes out from Bloomberg. Really important to hear what UBS is thinking in terms of rate cuts, right? So basically you got the market, the bond market, the money markets pricing in, right? Money markets, bond markets, they're known to be the smart money, right? Where smart money trades, where there's smart money traders are. They're basically pricing in that for next year, by end of next year, there's about a 75 basis point rate cut that is expected. Okay, not so big. That's about 3 rate cuts next year. And obviously, this can change with new information and the dynamics in the markets. But what's really, really interesting is this article talks about UBS's views, and there's a couple of strategists who believe there's going to be a deeper rate cut than 75 basis points. So let's get into the article. The title basically says that UBS strategists see far deeper Fed rate cuts than what markets are pricing. All right, so how deep are these rate cuts? Well, when we get into the article, it says the Federal Reserve will cut rate cuts by 275 basis points next year. This is nearly 4 times more than what the markets are pricing, strategists at UBS investment banks predict. So basically, they see that 4 times more of rate cuts are expected by the end of next year. And the biggest thing is they expect this as soon, rate cuts to start as soon as March. So in the second paragraph, it says a continued decline in inflation will enable central bank to start easing policy as soon as March, with rates likely to cut in large increments typical of an easing cycle, says the 2 strategists. I'm not going to say their names because I'm going to completely butcher it. But they basically see the rate cut cycle starting as soon as March, which basically means one thing, right? What does that mean? That means that they probably see a hard landing recession, right? Because the bond markets that are pricing in 75 basis points, that's not so big of a rate cut, right? Even if you do 100 basis points of cuts, you're still above 4%, around the 4% mark, right? So it's still high, right? When you look at how much we've hiked rates in the past year. Now, they say it's typical of an easing cycle to see large increments happen, right? And what is this typical thing? That typical thing of an easing cycle that generally happens because conditions are worsening. Now, when you get into the third paragraph, it says, they say, those strategists basically say, we don't see conditions for why this time is different. When you look at previous, recessions, 2008, 2000, 1980s, and so on, right? They've all amounted to very quick and large increments of rate cuts. Even 2020, right? You had, before COVID, right, in 2019, you had a large increment of a rate cut 6 months prior to the COVID pandemic hitting. You had a large increment of a rate cut, right? We're not talking about 25 basis points, right? 50, 75, and so on, right? So these strategists see the same thing, that if this is likely to be a hard landing, you're not going to get just 25 basis point rate cuts. You're going to get right there, right away with a large increment. Could be 50, could be 75, and so on. Right? Now, going on in this article, the strategists also say, quotes, inflation is normalizing quickly, and by the time we get to March, the Fed will be looking at real rates which are very high. So they basically see that inflation will be coming down quickly, real rates will be quite high up there, and this will have already translated to also more damage being done in the economy, the job market, and so on by the time we get to March, which may start to create and cause the Fed to come out and start cutting rates in large increments. Or who knows, right? Could be later on. They could be wrong about the March view. It could be maybe June, it could be later on. Or they could be completely wrong about the hard landing, right? But very interesting here that they do see the large increments starting March of next year. And when they say typical easing cycle, we're talking about that it doesn't end there. There's not 275 basis point of cuts and then that's it. Like, you're going to get more cuts after that because damage is being done, because the damage has already been done in the economy. They also say in the next paragraph, it says, the strategists expect benchmark federal funds rate to fall to between 2.5% to 2.75%. So, you know, we're at plus 5%. We're going to see that drop down to 2.5% by the end of 2024. And then they see the terminal rate hitting at around 1.25% by 2025. So almost close to, again, back to zero, right? Not exactly to zero. You still got a lot of ammunition from 1.25 down to zero, but still that's quite low, right? And they expect this 1.25% in the Fed funds rate to hit early 2025. And their view is, why do they have this view? Now here they get into the view. Their view is based on expectation that the U.S. economy will slide into a recession by the second quarter. So they basically see that, okay, second quarter, you know, of next year, you're going to see the recession begin, and it's not going to be your typical recession, which is thus why they think those big rate cuts are going to happen. Now, in contrast, the money markets are pricing in Feds to cut 75 basis points starting July. So, a contrast to the view of the UBS strategists, the markets, the smart money that I was telling you about, they think that, okay, these rate cuts are actually going to come in July, starting July. And you're going to get a total of 3 rate cuts, total of 75 basis points of cuts by the end of next year. So, there's going to be about 3 rate cuts. Obviously, this can change, right? Obviously, the markets, the bond market, the smart money can change things quite quickly. We've seen that before. We've seen the bond markets flip and flop here and there because they also get it wrong. They're not right all the time. They may be time to time, but they have a better idea, you know, where rates might be heading towards. But the magnitude and the amount really depends. How bad is this recession or this hard landing going to end up being? So it then goes on to say, to support their forecast, they point out to easing cycles over the last 3 decades where the group of 10 central banks, excluding Japan, have tended to cut rates by an average of 320 basis points over a period of 15 months. So they looked at the, you know, couple of the large 10 central banks out there, and they said, okay, generally when they go into an easing cycle, right, and all these central banks around the world, right, we're not just talking about the US. When you look at Canada, when you look at the European Central Bank and so on, right, they tend to be quite globally coordinated. When one's hiking rates, the others start to hike rates. When they're starting to cut rates, the others will also join on cutting rates, right? So they looked at them and they said, okay, on average, when they get into the hiking rate cutting cycle, it tends to be about 320 basis points over the 15-month period, right? So, you know, that's where another point to support their forecast. They also say, we think we're going to have a normal cutting cycle. Every single central bank, bar Japan, will be easing a lot more than what the markets are pricing. So this will be very typical. You think you're going to get 75 basis points, 50 basis points? No, there's going to be much more, as I've already mentioned. Wall Street banks remain divided on the outlook of policy easing. Morgan Stanley anticipates deep cuts, while Goldman Sachs Group forecasts fewer reductions and a later start. So again, confusion, and you can see that. You can see that in the bond market. You can see it in the outlooks. You can see it in even the stock market. You know, if you look at the Russell 2000, it's been down for the whole year, while, you know, the top magnificent 7 tech stocks are rallying, while the other stocks in the S&P 500 are, you know, haven't seen much strength. So you're seeing that divergence there. and we have yet to see those big top tech stocks feel the blow, right? And if you look at the previous also earnings for some of these tech stocks, they posted not bad earnings, and the reaction for many of them was you saw a selling reaction right away, right? Which basically tells you that, hey, if good news wasn't, good news, then shouldn't bad news be bad news also, right? I think eventually you'll get to the point where bad news will start to be bad news, right? So far, you're not, that has changed after earnings. You did see some weak data points and the markets took it in a positive way. So that means that bad news is back to good for the markets. Bad news is good news, right? But there will be a point where I believe that once data starts to really worsen off, bad news will be bad news, and then you can see a reaction in the equity markets and the stock market. Now, lastly, it talks about the ECB. So the UBS also gave their views on the Eurozone. And they said that the European Central Bank would delay their policy easing. They expect the ECB to commence its cutting cycle after the Fed. So they're going to look at the Fed. Everyone's looking at the Fed. When's the Fed's going to cut? And then the ECB from June, they expect that you're going to get a 75 basis point rate cut. And money markets, on the other hand, are pricing 100 basis points of easing starting as soon as April. So interesting, right? Reversed here. They think that ECB is going to cut April, while the money markets are pricing in ECB is going to be cutting more, and they're going to be cutting early. And they expect that the US is not going to be cutting early and will be cutting less than the ECB, while UBS thinks the reverse. That, no, actually, ECB is going to be cutting later. It's going to be cutting a little bit less, and the Fed's going to do more. What I think is that if the Fed's gonna cut 300 basis points, right? I think the ECB is also going to be cutting aggressively as well, too, right? And it may not be, a long delay. It may be sooner than later. It all depends how bad this recession gets, right? So overall, my whole view on this article, again, I'll put the link in the description so you could read up on it as well. The whole idea behind this article, the message that I got is that, you got top investment banks out there with different views, right? And with UBS looking at everything from Europe to, US and so on, there are cases to be made, like you see here, that, you could get deeper cuts. But don't think, right? The narrative that the media, maybe realtors and so on, are going to push out is that rate cuts are a good thing and things are going to bounce right away. Although, yes, rate cuts are good. That's the time also to be buying and whatnot, which we'll talk about later on. But the initial reaction, if we're talking about short term, is that when that starts to happen, it's because shit is hitting the fan. Things are getting worse off, right? So, and you see it here, UBS just telling you, like I've been saying on this channel for a long time, right? If you're getting those rate cuts, those deep rate cuts, so 275 basis points, it's because you're going to see that recession, right? So let's see. Maybe they're right. Maybe they're wrong. Maybe they're completely wrong on the timeline. Maybe they're right in terms of the recession, the deep recession hitting, but maybe it happens closer to the end of 2024, maybe beginning of 2025. Anything's possible. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.